How to prepare your credit to buy a house. If you're getting ready to buy a house and you're planning on getting a mortgage or a home loan, it might be a good idea to prepare your credit. Credit scores can not only affect your ability to qualify for the home loan, but it could also impact your interest rate as well as mortgage insurance if you are putting less than 20% down. One of the first things that is important to understand is that there is a difference when a home loan lender pulls your credit versus when you check your own credit score online. This is very, very confusing, and we have this conversation quite often. So it's one of those things that there are so many different types of algorithms that produce different credit scores, and they vary based on how we're getting the credit score. So if our credit card company is giving us a credit score, it's a scoring model for that purpose. If we go to buy a car, then the car financer that's giving us our credit score is going to be different. The algorithm is different for that. When we get a consumer credit score, the algorithm that drives that particular score is different. And then again, when we go through the home loan process, the credit scoring model that drives the scores used to obtain a home loan are different. So I know it's very confusing, but the only real way to know your credit score for a mortgage is to have a mortgage lender pull your credit. This is something you would typically do during the application process. However, prior to applying for a home loan or mortgage, it's still a good idea to check your credit score online. And these different services out there will give you a general look at your credit score. Just know it's going to be different when you actually complete the home loan application and go through the mortgage pre-qualification process. Before we talk about how to prepare your credit score to buy a house, let's first talk about what minimum credit scores are required to obtain home financing to buy that house. So FHA's minimum credit score is a 580 when putting less than 10% down. So you can do FHA's 3.5% down payment requirement down to a 580 middle credit score. Very important, though, to understand that not all lenders, even though FHA says that that's what their credit score requirement is, it doesn't mean that all lenders across the nation are going to allow for a 580 minimum credit score. And if they do, sometimes they're going to require additional guidelines or maybe additional reserves or maybe a home buyer class or things like that, because the lower the credit score could mean that there's a higher risk associated with that loan. And that's pretty much the same when we talk about VA. What's interesting is the VA actually doesn't post a minimum credit score requirement for VA home loans. They leave that up to the lending community and lenders to decide the credit risk and whether somebody borrowing money to obtain a home loan can actually pay the money back. So when we think about VA minimum credit scores, if you Google that, you're going to see a variety of responses. That's because, again, lenders will impose what their criteria is from a minimum credit score on a VA home loan. Now, conventional conforming loans, so that's going to be Fannie Mae and Freddie Mac, they actually do have a credit score posted, and that is a 620 minimum credit score. So if you have a lower credit score than 620, and again, remember from a lending standpoint, there are three major credit bureaus that are being pulled: TransUnion, Equifax, and Experian. And from a lender's perspective, they're going to take the middle credit score between those three scores. So if your credit score is under a 620, then you're probably not going to be eligible for a Fannie Mae or a Freddie Mac conventional conforming loan until that credit score gets up. While these are the minimum credit scores, keep in mind the better the credit score, the better the interest rate and the terms, depending on the home loan that you're obtaining. Okay, so let's get into the best ways to prepare your credit score for buying a house. First, make your payments on time. I know it sounds crazy, right? But paying your bills on time is really the biggest thing that is going to leverage that credit score. I often have seen people that have had perfect credit for years and years and years, and they have one 30-day late payment, let's say on a credit card. That can drop the credit score anywhere from 80 to 100 points. So when I say paying your bills on time, it is a game changer and can definitely have a big impact on your home loan pre-qualification. Now, what is considered late? This is important. It's a 30-day late payment, meaning that maybe your payment is due and you have a grace period and you pay it during the grace period or just after the grace period. Maybe you have a late payment fee, but until it goes 30 days late, that's when it gets reported to the credit bureaus. So really important to understand, 30 days or more late, that's where the damage starts to happen. on our credit reports. And if that late payment was in the last 12 months, this is even a bigger impact to the credit score. So for example, if you're going through the home loan pre-qualification process and maybe you just had a 30-day late payment on a credit card 60 days ago, the fact that that late payment is so recent, it is going to negatively impact the credit score and potentially the ability to get pre-qualified because it weighs heavier in that overall credit score. Now, the further that late payment gets from the point in time that your credit's being pulled, so let's say it was a year ago, it's less of an impact on the credit score. So the timing of when that late payment was versus when you're going through the home loan pre-qualification process is really crucial. The second item is credit utilization. So first, it's important to know that if you don't use your credit cards within a 6-month period, then your credit cards are going to become inactive from the scoring standpoint. So if you don't believe in leveraging or using, let's say, credit cards, that's okay. Go to dinner, go to Starbucks, you can pay it off. But just that activity during every 6 months is important because that is going to feed into your credit score. And then the second part of that is keeping your balances on your credit cards at 30% or lower of the limit. And this is really important. I see people all the time that maybe they use a credit card for work. And maybe it has a $10,000 limit. And for work, they're maxing it out every month, even though they get reimbursed and they pay it off. If at the point in time that the lender is pulling the credit and that credit card is essentially maxed out, or the balance exceeds 30% of the limit on the credit card, you're going to start to see the credit score be impacted negatively. So the sweet spot is 10%. So keeping balances at 10% or lower of the limit. But anywhere between that 10 and 30% is fine. Once those balances on credit cards start to exceed 30%, you're going to see a potential decrease in the credit score. And this is even if you've never had a late payment. This is what's so crazy about it. Because the utilization, the credit utilization is a factor that drives the credit score. And a lot of people don't realize that. So now you know. The third thing is know when to pay your credit cards. Even if you pay your credit card off every month. If you don't pay it at the right time, it's not necessarily benefiting you. You can contact the creditor and ask them when they report to the credit bureaus. If you're paying that credit card off, plan to pay it prior to when the creditor is actually reporting it to the credit bureau. That's going to help maximize your credit score. And finally, this is really, really important. If you want to buy a home and you know you're going to use a mortgage, be sure that you actually have an experienced mortgage lender pull your credit report prior to you doing anything. We see this often where people maybe have old collections and they just have it in their head and they want to get right and get ready to buy a house and they think they're doing the right thing by going out and paying these old collections. But here's the deal. If you pay a very old collection off without talking to the creditor appropriately, and that collection account now shows as a paid derogatory debt, the issue is when you do that, you're bringing a very old, kind of outdated account current. So that can decrease your credit score. So if you're going to pay off a collection account and it's an old collection account, stop. Don't do that until a mortgage lender has given you the green light to do it and has educated you on how to do it if it's needed for the home loan. And it may not be. It may not be a requirement to obtain a home loan. So don't go and pay an old collection if it's weighing on your shoulders. We see this quite often with medical collections, right? So one of those things that, again, a lot of people don't realize. They think they're doing the right thing by paying an old collection, but it could actually drop your credit score. So stop and talk to a lender first. And then lastly, we have people that have closed their credit cards and the credit score drops. I know, it's crazy. But again, part of what's driving a credit score is your revolving available balance on your credit cards. And so if you, let's say, had one credit card and you've paid it off and now you're going to close the account, that good credit card, that good trade line is no longer going to be reflected in your overall credit score. So it's okay if you don't believe in carrying credit card debt. I totally get it, but keep the account open, keep it at a zero balance so you're not paying that interest if that's your position, and just make sure that it's there because, again, being there is helping you leverage that overall credit score.
Why are credit scores different between the three credit bureaus?
After 25 years in home lending, this is a question I get asked all the time. When it comes to credit scores, this can be confusing. Not only that, when it comes to credit scores for home loans, it can be even more confusing. A credit score is a very important part of the home loan process because it impacts your ability to qualify for the loan. It could impact your interest rate as well as the loan program that you are eligible for. So let's get into why credit scores differ between the three credit bureaus. And be sure to stay tuned until the end where I talk specifically about credit scores and home loans. The three credit scores we're talking about are Equifax credit scores, Experian credit scores, and TransUnion credit scores. Keep in mind, these are three separate companies who don't share information with each other. They also have different scoring models. Therefore, they compute things like late payment, credit history, balance to limit ratios, etc. differently. This can result in the variation of credit scores that you might see. One might think that they receive all the same information, but they don't. Not all creditors report to all three credit bureaus. In fact, creditors have to pay to report to credit bureaus, so that would be the reason why they may only choose to report to one as opposed to all three. So that's why credit scores are different between the three credit bureaus. But wait, there's more! When you're looking online at your credit score from your credit card company or your bank, or maybe you just went to one of those apps and you're monitoring your credit and you're looking for your score, those credit scores are not going to be the same credit scores that a home lender is going to use when you go through the home loan pre-qualification process. And that's because mortgage lenders are required to use certain credit scoring models that are much different that we receive through a bank, a credit card company, or even online when we're pulling our scores. So you might be saying, Kelly, how do I know my credit score for a home loan? The only way to truly know your credit score for a home loan is to have a mortgage lender pull your credit. And that happens when you go through the pre-qualification part of the process. Once you've completed that application, your credit's going to be pulled, and then a mortgage lender will be able to tell you what your three credit scores are. Listen up, the number one thing that drops your credit score. Today we're talking about one of the most important pieces of qualifying for a home loan, which is your credit score. Your credit score has many components that can cause your credit score to either go up or down. When you apply for a home loan, one of the first things that's going to happen is your credit is going to be pulled by the lender. This is because your credit score can have a significant impact on whether or not you qualify for a home loan. Today, I'm going to discuss the number one thing that drops your credit score and a few tips on how to avoid this. You may be surprised to learn that the number one factor that carries the biggest weight on your credit score is payment history. I know, right? What factors into your payment history? Well, on-time payments matter. And really, when we kind of drill that down, here's what the crux of the whole late payment thing is. An on-time payment means a payment that's not 30 days late. That's what an on-time payment means. So if your payment is due on the 1st and you pay it on the 5th, but it doesn't get reported 30 days late until, let's say, the 30th, then as long as it's paid before that time, you are not going to have the 30-day late payment reporting back on your credit report. You want to know when these creditors are going to report to the credit bureau. And it's not always just when you pay the payment, because the creditors have their own billing cycle. So you can always contact the creditor and you can ask them at what point they're reporting to the credit bureaus. And that will help you know if you need a little more time to pay, but you absolutely want to pay before that 30-day drop dead date. Now you know the time frame based on the creditor. So the number one thing is 30-day late payments. And I will tell you, I have seen people that have 750 credit score, one 30-day late payment, just one. If it's recent, can drop that credit score 80 to 100 points. That's the impact. That's why this is so important. And it feels to me kind of like it's like, hello, no brainer, Kelly, but really it is the one thing. All right, so maybe you had a late payment and you are wanting to buy a home and go through the home loan process. How is that late payment going to impact your home loan qualification? Well, here's the deal. There's a lot of different answers to this. And remember, credit scores are an algorithm, and the lender's going to pull the three credit bureaus, so Experian, TransUnion, and Equifax. Not all creditors report to all credit bureaus, so you will potentially see some variation in those scores. But let's say that the 30-day late payment is reporting to all three credit bureaus. Then what's going to happen is, because it's so recent to your home loan pre-qualification, It may drop your score to a point where maybe you can't qualify now, but here's how it works. The further you get away from that 30-day late payment, your score is going to start to increase. And from a lending standpoint, you're going to have a better chance of qualifying for a home loan. Now, this doesn't mean that if you just had a 30-day late payment, you can't qualify. It kind of depends on what else is going on in your credit profile. So if you, for example, had an 800 credit score and you had one 30-day late payment and it was last month and maybe now your score is 700, it doesn't mean you can't necessarily qualify. This is why working with an experienced home lender that really understands credit and the implications of a late payment and the home lending guidelines will really help you with success. Now, secondly, if your credit score is lower, so you had the 30-day late payment and maybe now your credit score is a 700 versus an 800, let's say, it could potentially impact your interest rate. It may impact the home loan program you can qualify for. So lots of things going into this mix. The way that interest rates work on home loans is the lower the credit score, the higher the interest rate. That's just a really good general type of understanding about how it works. But on conventional conforming home loans, the higher the credit score, the better the terms of not only the interest rate, but if you were putting less than 20% down, your credit score is also going to drive the cost of the mortgage insurance. FHA is different and VA doesn't have mortgage insurance, so you don't have to worry about it there. But in summary, the credit score is going to impact not only your ability to qualify for the home loan, but potentially the interest rate too. Here are a few tips to avoid making that late payment. Number one, make an online account with your credit card company and set up an auto payment of the minimum amount that's due every month to be paid by a certain date. That way, at least the minimum gets made. Now, you can always make additional payments if that's what you're used to doing, but at least that minimum gets made, which will make sure that you don't have that 30-day late payment. Secondly, use your smartphone. Set reminders. Call your creditor. Find out when the billing cycle is. Find out when they're reporting to the credit bureaus. And then make sure that you know the drop-dead date. If you're struggling to make the payment, it's got to be made by a certain date and a certain time, because it's not just the date. A lot of these creditors, maybe they're East Coast time and maybe you're West Coast time. If you're missing the payment by the time that the creditor has set, let's say you're on the 29th day and it's 6 o'clock and the cutoff for the creditor is 6 o'clock Eastern Standard Time, and you pay at 7 o'clock Eastern Standard Time, chances are now you're rolling into the 30-day late payment. So really having control and organization around knowing the due dates and actually the time frames, if that's something that you're really cutting it close, got to know the time frame as well. And tip number 3, if you had a 30-day late payment and maybe something happened where it really wasn't your fault, all kinds of things come up, contact the creditor earlier than later and start to have some discussion. So if it was their fault, or maybe the auto pay didn't post, or whatever, there's a million different types of scenarios. But if there is a 30-day late payment there and it's not your fault, you certainly can dispute it with the credit bureaus. But prior to doing that, just contact the creditor and work through it. Many times, if they can document it was their fault, they'll just remove it. Now, what if it was your fault? You can contact the creditor. You can ask for a courtesy removal of the late payment. It's not easy, guys, so don't automatically think that that's going to happen, but it's worth a phone call, and I always recommend making the phone call. If it was your fault, call, see if they'll remove it. If not, then it is what it is, and you'll have to deal with that 30-day late payment. But remember, every month that you proceed forward without having any 30-day late payments, then your credit profile will start to rebound. How are credit scores determined? Have you ever wondered how exactly a credit score is determined? Just pay your bills on time and you're going to have a huge credit score, right? Well, not necessarily. There are actually 5 different components to your credit score. And today I'm going to break it all down for you. Why? Because the credit score is a major determining factor when it comes to home loans. Your credit score will determine your eligibility for a home loan as well as your interest rate depending on the home loan that you're taking out. So let's get right into what you need to know. The 5 components that determine a credit score are payment history, amount owed, length of credit history, new credit, and types of credit. So let's tackle each one of these so you'll know exactly how to maximize your credit score. We'll start with new credit. New credit represents 10% of your score. This refers to the number of new credit inquiries you have in your credit report. In addition, it also refers to the number of new accounts that you have on your credit report versus what we call seasoned accounts, which are just accounts that you've had for longer. Credit scoring algorithms tend to favor more seasoned accounts. So if your score is mostly new credit, it may take some time to get the benefit of those accounts becoming seasoned. Remember, this section also takes into account new credit inquiries. New credit inquiries can affect your score by 1 to 3 points per inquiry, but keep in mind, if you are shopping for, let's say, a home loan, and you have multiple lenders pull your credit, as long as it's done within the same window of time, and generally the credit bureaus say 30 days, then that initial lender inquiry is only going to impact your credit score by that 1 to 3 points. So if you have 10 lenders pull your credit within the same, let's say, 1 week time frame, and they're all home loan lenders, then in theory, that credit score is only being impacted by that 1 to 3 points. But good news, if you're checking your own score online, this does not count as a credit inquiry and won't affect your score. Next up, types of credit. This also represents 10% of your overall credit score. What this refers to is a mix of credit types such as installment loans, revolving credit accounts, which are credit cards, and even home loans. Some examples of installment loans are student loans, auto loans, and mortgages because they are fixed for a period of time. Examples of revolving credit are mostly credit cards and many times home equity loans. The algorithm favors responsible use of a mix of credit, paying bills on time and not exceeding 30% of your limit on your credit cards is a really big deal. In addition, the credit score algorithm favors credit usage. You may be surprised to learn that having revolving accounts and not using them could actually hurt your credit score. But again, it's all about responsible use. Now let's talk about length of credit history. This is 15% of your score and refers to the payment history as well as the length of time you've had the account. This section is one that grows over time. When you close an account, it can drastically affect your credit score, especially if you're closing out your oldest credit card. The next two I'm going to talk about are the most important and represent the largest percentage of your credit score. Amount owed represents 30% of your score. It's made up of credit usage and relates to your credit card usage. It's looking at your balance to limit ratio on your credit cards. The credit scoring algorithm wants to see that you're using your credit cards and that you're using them responsibly. Ideally, you want to keep these balances on your credit cards at 30% or lower. So if you have a limit of $1,000 on a credit card and your balance is $300 or less, awesome, that's going to help maximize your credit score. But if you have a $1,000 limit on your credit card and you owe $800 or $900 or $1,000, now you don't have a lot of remaining available credit, and that's going to actually drop your credit score. In a perfect world, to maximize the benefit in the component of a credit score, keep those balances on your credit cards at 5 to 10% of the limit. And now for the biggest impact to your score, drum roll please, 35% of your credit score is made up of payment history. This is huge. Paying your bills on time really does make a big difference. And what does that mean? What does on time mean? Well, when it comes to the credit scoring algorithms, if you're paying within a 30-day window of your due date, then it's not going to report late. But if you've paid 30 days or more outside of that 30 days, 31 days, it's going to show on your credit report through the credit bureaus that you've had a 30-day late payment. And the credit bureaus will track 30 days, 60-day late payments, 90-day late payments, up until charge-offs and collections. So the damage can be significant to a credit score with just even one 30-day late. The other component is how recent the late pay was. If it was a long time ago, like 2 years ago or longer, it may have a little impact on your credit score. But I've seen recent late payments drop credit scores by 100 points or more. I am not kidding. And not only do the late payments affect your credit score, but they could also affect your ability to qualify for a home loan as well. So if you remember nothing else from this video, It's to pay your bills on time, set up auto pay or whatever you need to do to ensure those bills get paid on time. Because when I talk to clients, honestly, it's because they went on vacation or something to get forwarded. It's not because they didn't have the money to pay it. And that one oversight, that one mistake can cost you greatly when it comes to that credit score. As a bonus tip, if you're somebody that pays off your credit card balances every month, just know that depending on when your credit report is pulled, that balance still may show the full amount that you had charged. This is a really big deal because we do talk with a lot of clients that do large payments on their credit cards or in fact pay them off every month. But if we're pulling credit when the balance is not yet reflected, and let's say it's a $10,000 limit on the credit card and somebody just went on vacation and they owe $10,000, that scenario is going to drop your credit score. So the way around that is call your credit card company and ask them when they report to the credit bureaus, and then plan to pay your balance or pay it down or whatever you're doing, pay that payment prior to that date that they're actually going to report to the credit bureaus. This will help you really achieve making sure that your credit score is maximized, especially important if you're going through the home loan process. You may be wondering what credit score is needed to get a loan. We're going to take a look at various loan programs and talk about how credit affects each one. You'll want to be sure and watch to the end because I'm also going to give you some tips on how to maximize your credit score, which are so key to this overall getting a loan process. Now, not only will credit score affect your ability to qualify, but it's also going to impact your interest rate and potentially the cost of mortgage insurance. This is important. And by the way, if you haven't already subscribed to this channel, please take a moment and do so. I am always updating information about the home loan process, and you're going to want to subscribe and be sure that you get those triggers and notification if you're going through this process, because this is the real scoop. All right, the minimum credit score on conventional is about 620. All right, so I'm talking about conventional conforming loans. These are loans that are backed by Fannie Mae or Freddie Mac, which are government-sponsored enterprises. Essentially, they purchase conventional loans in this country from lenders. So 620, that's going to be the minimum with conventional conforming loans. FHA, now this is where with FHA will go down to a 580 credit score with minimum down payment, which is 3.5%, but they'll actually go down to a 500 credit score with 10% down. But keep in mind, we got to back up here because even though that's what FHA's guidelines are, most lenders have what is called an overlay, so additional criteria on top of those posted guidelines. So not all lenders out there are going to offer loans down to those types of credit scores. And on average, I would say for FHA, kind of think 580 or higher. Some lenders cut off at 600 minimum credit score. Some lenders cut off at 620. Some even cut off at 640. So the minimum credit score is going to always vary by lender. These are just the mainstream program guidelines themselves. Now VA, what's interesting about VA is VA actually doesn't have a minimum posted credit score. However, back to the whole overlay concept, most lenders will cut off on VA right around 580 on the credit score. The thing I would really caution you about though when we think about credit score is realize that while it's a very, very important number, especially on a conventional loan, but on all loans, the next part of the credit conversation is it's not just about score, it's about what else is going on in that credit profile. So I have seen people that actually have a higher credit score, let's say it's a 640 credit score and they're applying for an FHA loan, but they can't obtain FHA financing because the credit profile itself does not meet the lending guidelines. So there's two parts of this process, kind of like the two-step, right? So the first step is credit score and what is it? Then the next component, the next step is what is the credit profile and does it meet the lending criteria? Keep in mind, the true way to know your credit score when you're going through the home loan process is to have a home loan lender pull your credit. There are so many different algorithms and so many different types of credit scores that based on how you're getting that information is going to vary. So if you're just online, you're checking your own credit score, or you're using the credit score that your credit card company gave you, or you just bought a car and they're giving you your credit score, it's not going to be what the home lending credit score is, simply because there are so many different algorithms that drive credit scoring models. Here are my 2 tips to maximize your credit score. 1, making sure that you don't have any 30-day late payments reflected on your credit profile. So that's 30-day or more. The way that credit reports is 30-day late payments, that's the first hit. 60-day late payment, that's an even harder hit. 90-day late payment, that's gonna really whack the credit score. 120 days, and it goes from there. But initially, one 30-day late payment can drastically drop your credit score. So we wanna be sure that you're thinking about, especially this time of the year, vacations, distractions. Think about setting up auto pay so you don't have any late payments. And the second tip is keeping your balances on your credit cards at 20% or lower of the limit. Now, it used to be 30, I'm saying 20. Sometimes though, it's an individual thing. Sometimes it's having a $10 balance on that credit report. But in general, if you can work to keep your balances on your credit cards at 20% or lower of the limit, that is going to help maximize your credit score. So let's walk through that. If you've got a $1,000 limit on your credit card, you're not going to want to owe more than $200 as you lead up to going through the home loan process. $200, 20% of $1,000. That's the math. So now you have a lot more information on what credit score is needed to get a loan. Let's go through the top 5 credit myths, and I think you're going to be surprised by some of these answers. If you pay to have your rent payments reported to the credit bureaus, does this impact your mortgage industry credit score? The answer is no. Oh my gosh, are you kidding me? No? Like, you're going through the hoops, it's all over the internet. Get your rent payment reported and it's going to improve your credit. It does, but not on the mortgage industry algorithm for the scores and the models that the mortgage industry uses. So why is that? Well, the versions of the credit reports that are used for a mortgage credit pull going through the mortgage loan process are very outdated, and they haven't been updated for years. Now, that is soon to change, but today these models are years old, which means that they were originated prior to this whole rental payment being reported to the credit bureaus. So the algorithms themselves for the mortgage credit pull have yet to be updated. So if you're paying for that, it could impact your other credit score models, but not your mortgage credit score. If you apply for a mortgage with 2 different lenders, 15 days apart, it will only count as one hard hit inquiry on your credit report. What do you think about that one? That is false. Why? Because there's so much conversation out there about it being a 30-day window. So in my scenario, I said 15 days. Why is that false? Because one of the 3 major credit bureaus out there that lenders use to gather data from when you go through the home loan pre-qualification process, one of those 3 credit bureaus has a 14-day window. Additional shopping or credit pull after 14 days will not impact 2 of the bureaus. It does impact 1, which could mean that it could change your credit score for the subsequent credit pulls after 14 days. Number 3, removing a medical collection account can actually cause your credit score to drop. It's true. Crazy, right? Now here's the thing, when it comes to collections of any kind, whether they're medical or non-medical, it's important to talk with your mortgage lender that specializes in credit analytics, because everybody has a different kind of scorecard. Think of it that way, a credit scorecard. And that's a real thing. There really are credit scorecards. So depending on your history of credit depth, credit performance, etc., it's going to decide where you fall in that credit scorecard. So even though it feels kind of counterintuitive, you think that you're going to go pay a medical collection and that you're going to have it drop off and that's going to increase your credit score dramatically, that may not be the case, but it could be the case. So it really depends on your particular scenario. Disputing third-party collection company accounts can help your credit score. False. Not on the mortgage-rated credit scoring algorithms. I know, again, it's something that's out there. People talk about it all the time, but it's not necessarily the case. Everybody has their own scorecard, and it is unique. It's kind of like a fingerprint. It's unique to you. So ensuring that you're talking with a mortgage lender that specializes and leverages credit analytics, we can actually go into your credit report and start to play with it and say, if this account is disputed, here's what happens to the score. If this account is eliminated or removed from your credit report, here's what happens to your score. I mean, it is so fascinating, but not all lenders do that or take the time to do that. So be sure when you're talking with a lender and interviewing a lender that you're asking that question if it's important to your credit scoring model. And number 5, closed revolving credit accounts can still be factored into your revolving utilization. Yes, that's true. Very often we'll see somebody that has closed maybe a credit card that's a revolving account, and maybe they have a $10,000 limit. They happen to owe $9,000, let's say, and then they close the account. That ratio of owing $9,000 versus the limit of $10,000 in this scenario, that's still going to impact the overall credit scoring model. And a lot of people just don't realize that if they close an account, they think that it's just done and over and it's not impacting their overall score, but that is just not the case. Closing an account, whether you owe money on it or not, could negatively impact your credit score. Again, always important to talk with your mortgage lender before you do any crazy things if you're thinking about buying or selling a home. When it comes to credit, don't try to navigate all of these nuances on your own, and you don't have to. Click the link below to schedule your personalized mortgage consultation with a KellyZitlowGroup team member.
It's all out in the media that student loans are coming out of deferment. So if you are somebody you know that have been in deferment on the student loans that you have incurred, and you are especially going to go through the home loan process, know that because of this shift, how it gets reported, meaning that if it's coming out of deferment and maybe you've been notified, but you haven't been able to pay a payment, maybe you've applied for the payment program where it's income-based repayment, there's so much happening out there that you need to know where you stand with your student loans, because what you don't want to happen, whether you are looking to purchase a home or honestly, whether you're just looking to rent a home or anything that's going to require your credit be pulled, you want to understand the status of your student loan and be sure that you're being proactive on this. And this doesn't just apply to people themselves that have taken out student loans. If you are a parent and you have co-signed for somebody else that has a student loan, my number one recommendation is reach out to the student loan servicer and ask for a status update. Are they reporting you delinquent? Because it's estimated 9 million people are coming out of deferment and going straight into collection. What does that mean with regard to a credit score and a credit profile? You can expect your credit score to drop dramatically if that thing hits collections. Now, can you unravel it? Can you work with the servicer and all that stuff? You can. But if we can get ahead of this and do that by reaching out to the student loan servicer, ask for a transaction summary of what is going on with your student loan. Are they reporting you delinquent? Did you even know it came out of deferment? But be proactive with this, guys, because I have seen things like this in the past, not exactly like this, because this is huge and it impacts so many people. But not knowing what is reporting on your credit report and thinking everything is okay, and then you are going to purchase a car or you're going to get your automobile insurance or you want to purchase a home. The timing of what is going to be reported through your loan servicer on your student loans can impact all of that. So be proactive, reach out, and better understand what is going on with your student loans. Now, if you're going to go through the home loan process, a few things we're doing to try to help protect people is, one, we're just having the conversation up front at the pre-qualification stage. And we're asking, hey, do you have any student loans? Or if you are a parent or a grandparent or somebody that is co-signed on student loans, especially important for you, this also will impact your credit if you don't get your arms around what is about to happen. Secondly, realize that if you are going through the home loan pre-qualification process, your lender may ask you to reach out to your student loan servicer and just get a summary, get a transcript of what's going on with your student loans. That way you all are aware and you're approaching your pre-qualification proactively. Here's what I'm afraid of, and this stuff happens. So a credit report for a home loan pre-qualification is good for 90 to 120 days. And that means you would have to get pre-qualified, find the home, and close within that time frame. Ours is 120 days. Some lenders have 90 days. Nevertheless, know that there's an expiration point on that credit report itself. So let's walk through this. Let's say you have reached out to your student loan servicer. You have been proactive, you know what's going on with your student loans, great. Get that to your lender, whether that's us or anybody else, so we understand what's going on. But if you're not being proactive, and let's say that the lender pulls your credit and your credit score is fine, they may require additional documentation to get into what's really going on that trade line from your student loan company. Because a lot of what we're seeing right now is student loans that were in deferment. The last active date or the last update date on your credit report is a year ago. It's 2 years ago. It's 9 months ago. So your lender is naturally going to go back in and need to update that trade line. And if they do that, and now you've missed your window and potentially that student loan has gone into collections and it's going to report you were 30, 60, 90 days, 120 days, whatever it's going to report, any of those scenarios can dramatically drop your credit score. So if you went in through the pre-qualification process, your lender said, great, good to go. Here's your pre-qualification letter. You get out there shopping. But during the process, they know that they need to update that trade line. If when they update that credit report or that trade line with, let's say, a credit supplement, it doesn't even have to be a brand new credit report. It can drop your score dramatically. So this is why I really just want to get this information out there that we're being proactive. Like, that's how we navigate things that happen. Let's all be speaking the same language. If you have questions about how this potentially impacts you or somebody you've co-signed for, do not hesitate to reach out, especially if you're going to go through the home loan process. And if you're not, and this is just kind of general awareness, that works too. Reach out to your student loan servicer and be 100% clear and aware of when your payment comes due. Have they turned you over to collections? Are they reporting you delinquent on your credit reports? And just know what that impact may be if in fact they are doing that, and get it resolved. I mean, be proactive. Also remember that if you are going to buy a home and you're thinking about using a government-backed loan, so FHA, VA, USDA, if you're thinking about that, part of that home loan process that lenders are required to do is pull a KVERS report. And we will pull the KVERS report up front. Let's say KVERS is clear. And a KVERS report essentially just says you don't have any federal debt that you've been delinquent on. But a lot of lenders are now going to also start pulling that KVERS report prior to close of escrow. So for all you real estate agents out there, just know that the student loan scenario and what's taking place, it can be a potential time bomb. So working closely with the buyer's lender, working closely with the buyer, we're all in the same conversation. We're going to do everything we can to navigate a smooth process. And part of that just comes down to clear, concise communication. So again, if you have any questions, don't hesitate to reach out to a Kelly Zitlow mortgage advisor.
You may be curious about ways you can build your credit to improve your credit score, or even how to establish credit if you don't have a credit score. You need credit to buy a house. Well, the answer is, if you're not using a home loan and you're paying cash, then credit won't matter. But if you do need to use a home loan to purchase a home, then the credit score can impact your ability to get qualified. So please understand that there are some programs out there for people that do not have a credit score. That doesn't mean not having a credit score because of bad or derogatory past credit, or maybe not having current credit. That means for somebody that truly has no credit profile at all, there are some programs out there that you could potentially qualify for. However, the guidelines around those programs are much stricter. And so they could potentially require more down payment. They could restrict the type of occupancy, meaning primary residence, second home, maybe potentially no investment properties. It's really going to come down to the lender and their approach on what to do with a loan application that has no credit score at all, i.e. meaning no credit profile. There are programs. I don't want you to think that there's not. It's just that they're limited and they're not as mainstream. Okay, so let's get into it. Now, how do you get credit if you don't have any credit? Well, the easiest way to actually get on the map with a credit score is to obtain a credit card. Now, I am not advocating credit card debt, but what I am advocating is using a credit card and the strategy behind it to be able to actually get a credit score. So here's how it works. Let's say that you apply for a credit card and that you have a $500 credit limit that the credit card company gives you. First and foremost, do not max that thing out. Do not spend more than 20% of the limit. So in a $500 scenario, you're not going to spend more than $100. So you're going to spend $100, go to dinner, go to Starbucks. You can spend $20. It doesn't matter. What they're looking for is activity on that trade line, on that credit account. After 4 to 6 months of having that credit card, then you will start to see a credit score pop up on your credit profile. That's how it works. Now, what if you can't get a traditional credit card for whatever reason? There is an option that's called a secured credit card. And in that scenario, you're going to go to your local bank and ask for a secured credit card. What they're going to want is, if you're not meeting whatever their guidelines are to give you a credit card without securing the limit, then you can give them the dollar amount. Let's say it's $500. You give the bank $500. They hold that for a period of time. Generally, it's about a year. And then they give you a credit card with a $500 limit. So that's called a secured credit card. And so what the bank is doing is securing your money in case of default. And sometimes with new credit profiles or people that don't have established credit, or maybe younger people that are just starting out, sometimes banks will want to do that. It doesn't matter, other than once you have that secured credit card, it works the same way. So if it's a $500 limit, you're going to, let's say, go grab a coffee and pay it off. You want activity on it, but do not spend more than 20% of the limit. That's going to help you maximize your credit score. And again, it doesn't matter if you've applied and they've given you a credit card, or you have to go the secured credit card route. After 4 to 6 months, you will start to see a credit score pop up on your credit profile. From a home loan perspective, why do home lenders really care about a credit score? Well, what they're looking at, and remember, credit score is just one piece of the entire loan decision-making process, but it's a very important piece because credit score generally will predict the default rate on a home loan, which essentially means that the higher the credit score, the lower the default rate, which a lender likes, right? They like to have a secured investment if they're giving you money. That's really what it comes down to. Take a peek at this chart. I mean, it is pretty incredible just to look at these numbers, but this tells you, and I think really helps us understand why lenders are so focused, why home loan lenders are so focused on credit score. So why increase your credit score? Because depending on the home loan program, a higher credit score could impact your interest rate, the cost of the loan, and potentially mortgage insurance if you're taking out a conventional loan with less than 20% down and have mortgage insurance. So credit score is pivotal to the terms of your home loan in some cases. I'm often asked, what is the difference between a soft credit pull and a hard credit pull? Well, the difference is, on a soft credit pull, it's not going to be a true hard inquiry on your credit profile, which means it's not going to impact your credit score. On a hard credit pull, it is going to show as an inquiry on your credit profile. Now, if you're really serious about going through the home loan process, getting a hard credit pull is key, because then the lender can see actually all of the credit scores and be able to set you up for success. The soft credit pull isn't going to give the lender the full picture of what they need to give you a true pre-approval. Now, a lot of people ask, is there a minimum credit score needed to obtain a home loan in today's environment? And the answer is there could be. It depends on the home loan that you are applying for. So every home loan program will have a different minimum credit score. Now, keep in mind, the higher the credit score doesn't automatically mean that your home loan is going to be approved, because there are additional factors that go into that home loan pre-approval, such as debt to income ratio, assets, the actual credit profile itself. The score is one thing, but what has happened in one's credit profile is also something else that lenders are looking at. So score is important, but actual reporting history of what's taking place in the credit profile is also important, together with that debt to income ratio, assets, etc. If your focus is building your credit score, be very careful not to close credit accounts. A lot of times people think that that's going to help boost up their credit score, and it actually can decrease the credit score. So here's my advice. If you have an old credit card, maybe it's a department store credit card you opened years ago, you haven't used it, and let's say it hasn't been active for 6 months or more. If you close that account, it's less likely that it's truly going to impact your overall score. But if you close a credit card, let's say you go to a retailer, they offer you one of those, like, oh, you get, 10% off if you open a credit card today. You open it, and then in 90 days, you close it, that could negatively impact your credit score. So it kind of just depends on what your overall appetite is for having lots of open accounts out there. Some people are just really concerned about it because of identity theft, etc., which I totally get. Are you in the process of wanting to buy a house or potentially refinance? Therefore, your credit score is going to be important. Then at this point, I would say don't close any accounts. Let your lender pull your credit report and give you advice. There are analyzers that lenders use that we can actually go into one's credit profile and see what will happen if somebody closes an account. So again, if it's an old account and it's been inactive for a long time, it's less likely that it will impact your credit score. But if it's a newer account or it has had activity over the last 6 months, the likelihood is if you close it, it could potentially drop your credit score. Today, I am going to break down some of the most common questions I get on this channel about credit. I only have a TransUnion credit score. I was told it's important to have all 3 of them if I wanted to get a house someday because they average those scores together. How do I begin working on Equifax and Experian? Okay, lots to chunk down here. First, you can get a home loan with just 1 credit score. So don't stress that you have to go and build out all 3 credit scores. So just know 1 credit score doesn't rule you out. Secondly, they don't average the scores. So the lending guidelines are going to take the middle score. If there are 3 scores, generally, most often that's going to be TransUnion, Experian, and Equifax. And then from a lending guideline standpoint, they're going to take the middle score of the 3 different credit scores. So the middle score is going to drive how you're going to be approved. It could potentially impact the terms of your loan, the interest rate, the cost of mortgage insurance if it's a conventional loan, etc. Not an average, it's actually the middle. And then lastly, how do you begin working on establishing Equifax and Experian? Well, a lot of people don't realize that creditors don't necessarily report to all 3 credit bureaus. So if you're very focused on establishing an Experian and an Equifax score, you're going to want to open a trade line or some type of credit with a company that's going to report to one or both of those credit bureaus. So you can easily ask if you're looking to open a new credit card, let's say, or maybe you're taking out a car loan. You can ask them, hey, do you report to all 3 credit bureaus? And if they say yes, then great. You have just met the last 2 credit bureaus that you're looking for. Keep in mind, too, that not all 3 credit bureaus are going to have the same credit score. And this is like something that blows people's minds because the time that they report is going to vary depending on the 3. Also, let's say you have multiple trade accounts. For example, you already have one with TransUnion. So let's say you're opening up a new credit card and now it's going to report to all 3 credit bureaus in addition to the one you already have reporting with TransUnion. So your score on TransUnion is going to look different because it now has 2 different lines of credit reporting on it, whereas Experian and Equifax may only have 1. So lots to unpack there. Hopefully that helps. All right, let's move on to question number 2. It's been bugging me why my Experian score is a full 50 points below the other 2 agencies. Now, I understand and appreciate everything you said about how scores can differ and why, but I still feel such a vast discrepancy should be investigated. 10 or 20 points I can understand, but something just isn't right here. Just one person's opinion. You did clear up a lot, though, and it is much appreciated. I hear ya. I do. But the reality is there's something going on with that one credit bureau that isn't replicating over to the others. And so the investigative work on trying to figure out what is it. Maybe it has newer trade lines on it. Maybe maybe it has less trade lines on it. Again, all the things I said in that initial video are going to be potential reasons why, but I don't know that I have a solution for you other than I hear ya. I hear ya. All right, number 3. My Experian score is 690. I am trying to repair my credit and have been making on-time payments, which caused Experian to go up. Awesome. I know how hard that is, so kudos to you. But yet both TransUnion and Equifax have remained at a low of 620 in the past months. What can I do as a consumer to have them reflect a more current upgraded score? What you want to do is really better understand what's reporting on those 2 credit bureaus and what is different on those credit bureaus as opposed to the Experian credit bureau. I would guess that Experian has maybe additional trade lines, or maybe has less delinquency, or maybe it has a credit card that has a lower balance to the limit, whereas maybe a credit card, for example, that's reporting on TransUnion or Equifax, maybe it's maxed out because you haven't focused on attacking that one yet. Maybe Experian had a less derogatory credit when you had ran into credit issues in the past. So again, like, this is really where kind of almost being a detective. You can get your copies of your credit report through annualcreditreport.com. It's free for all of us here in the United States. You can request it from each one of the credit bureaus. You can lay it out on your desk and just do like a line item comparison. And that's really going to show you the differences in what's being reported. So the way to get Experian and TransUnion score up is to better understand what's currently keeping the score at that 620, and then talk to a experienced credit or mortgage expert that can better understand what's happening, because then we can give you advice on, hey, do this, do this, do this to try to get that score up. But I love the fact and the diligence. I know it's not easy to reset, but guys, if I know anything, life happens. And sometimes you're going to run into situations where maybe you've had to go late on credit, or you had a collection or whatever. Just know that this too shall pass. With a focused plan, you can get yourself out of this. All right, number 4. So basically, each credit card company chooses which bureau they report to. Yeah, there's no additional response there other than that's correct. The creditor can report to no credit bureaus. They can choose to report to 1, 2, or 3. It costs them money when they report, so that's why some may only report to 1. So again, if you're really focused on increasing all of your credit scores because you are going to buy a house, or you're just in that mode of you really want to maximize but all 3 credit bureaus, understanding before you apply, hey, Mr. Creditor, how do you report and on what credit bureaus do you report on, will be helpful to you. The last one, how credit scores are determined. You need to tell them about FICO 8 score that they advertise isn't the credit score mortgage companies use, and could be up to 100 points lower than FICO 8, and also will knock you out of getting a house. These credit bureaus need to be sued. The best way to approach this is to know that there are so many different credit scoring models out there. And the type of entity that is pulling your credit for you to obtain credit in this example, that type of entity is going to drive which type of credit reporting model that they're using. So you're right, as a consumer, it can be so confusing because we all have access now to our credit scores. But the question is, what credit score do you have access to? And in this case, FICO 8 is going to give you a different score that may not be aligned with the credit scores that you're going to see if you're going through the home loan pre-approval process. So there's finally some headwinds taking place with regard to the mortgage industry changing the credit bureau requirements that lenders use. And frankly, the bureaus that we have to use, according to the guidelines, they're outdated. They haven't been progressing with all of the trends with regard to credit and credit bureaus. You may have heard 10T has been approved for the mortgage industry. So this is a big deal. What we don't know yet is just the timing in which it's actually going to be in play. There's a lot that goes into it because remember, from a home lending standpoint, and even if own lender, let's say, it's a risk-based business. So you have years of experience with these credit models that have proven and given you intel on repayment trends and history. So if you change that and you move into a new credit model, which is the 10T, let's say, and it will happen, it's just when, now you've got to reassess the practice of how you're going to determine repayment. Because at the end of the day, whenever you're lending money, the hope is that you get repaid the money that you're lending. And so, I know it's not necessarily a simple answer, but the 10T credit scoring model we're very excited about because it is going to be more of a trended credit type of profile, whereas the models that we use now are kind of like one and done. We take the picture, it tells us a story, but it tells us a story based on that moment in time. Whereas the 10T, again, is going to be trended over time. So if you're somebody that has a long credit history, if you're somebody that always pays off your credit cards monthly, it's going to now show different on a credit score standpoint than when compared to the current model. So we'll see. We don't know exactly when it's going to take effect, but finally we're seeing some headwinds there. Was that helpful? And do you have more questions? If so, drop it in the comments. You never know. I may be doing a video on it.